Hello and welcome to the latest episode of Damien's Market Update, which is the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Before I start the show, if you do enjoy it, you find it useful, do hit that like button, but also subscribe to the channel because I do this every month. And of course, any questions that you have, do put them in below the video on YouTube and I'll do my very best to answer them all. Now, March was the last time I did this show and March brought the end to Q1. Now, it was a very positive quarter for equity markets. If you want a broad benchmark to give you an idea, then the MSCI All Country World Index was up about 9% over those 3 months. And the standout performer was Japanese equities. Then you had US equities, of course, driven by some of those technology stocks. And the laggards were actually the FTSE 100, which only made around about 3%, as did emerging market equities. But if you were to pick one underlying theme to summarise that first quarter of 2024, then it would likely be that relentless surge in AI stocks and the Magnificent Seven, which in turn helped to push the wider US indices to new highs and by osmosis global stock markets too. In fact, we saw a wave of new all-time highs in US stock markets, the Japanese Nikkei 225, the German DAX, the Euro Stoxx 50 and even the Indian stock market. We even saw the Chinese equity market enter bull market territory, and in short, investment risk was rewarded throughout Q1. Conversely, bond investors weren't so lucky as the negative correlation with equity markets reasserted itself and yields pushed higher. But as we moved into April, there were signs that the stock market breadth in the US was finally broadening significantly, meaning that it was no longer just the Magnificent Seven doing all the heavy lifting. It would have passed a lot of investors by, but in March, in fact, there were rotations out of areas of the market that performed well in January and February and into other sectors that previously lagged, such as energy. Similarly, we started to see European and UK stock markets outperform those in the US, in contrast to what we'd seen earlier in the year. So that's not necessarily a bad thing for a bull market, but it was a sign that equity investors were starting to rethink their narrative as they moved into April. But it's also a reminder to look beneath the surface as to what is driving markets. So as an example, in recent weeks, I've been highlighting to 80/20 investor members via my newsletter of the importance of keeping an eye on the number of developing trends like the strengthening US dollar, rising commodity prices, particularly oil, and in turn, the upward pressure on bond yields. Now, these trends have accelerated through April, partly a result of the rising tensions in the Middle East. Now, the tensions helped push the price of oil to a 5-month high. Now, that's a high of $90 a barrel of Brent crude, which equates to a 20% rally so far in 2024. Now, this may have largely passed equity investors by, but bond markets have become increasingly twitchy and yields have pushed towards their 2024 high. Now, the 10-year US Treasury yield, as I make this, is about 4.6%, which is a level we've not seen since November. But it's not just oil that is rallying. Commodities more widely are also rising. If you take the S&P GSCI benchmark for commodities, that has risen by more than 13% so far in 2024. Now, that index is comprised of a number of commodities, but the largest constituent is in fact energy, which is oil and natural gas. There are things in there like gold and silver, but they make up a much smaller part of that index. It means the question now is whether during the rest of April and going into May, we will see commodities gain further momentum and break higher, causing inflation concerns to resurface. And if that happens, then don't be surprised to see commodities and energy stocks outperforming while equity markets more widely have a setback. It also remains the case that major central bank actions and rhetoric continue to influence markets. If you take the Federal Reserve, its recent decision to maintain its interest rates while signalling the potential future cuts were on the cards, gave equity investors a sense of optimism at the back end of March. And now this stance was mirrored by the Bank of England and the European Central Bank, which both suggested that they will soon shift towards more accommodative monetary policy. Now, that could mean potentially interest rate cuts at some point in 2024. If you look at the Swiss National Bank, it went as far as to announce an unexpected rate cut, which is sort of a sign that other central banks are also willing to take bold actions if needed. But the rising oil and commodity prices, along with higher than expected inflation data in the US, have muddied the waters in recent days. So much of that means that the market is now pricing in the Fed will only cut rates once this year, rather than the 3 cuts they'd previously been pricing in. And so it means the market is starting to consider the potential divergence in monetary policy between key central banks, with the Federal Reserve less likely to cut rates as soon as maybe the Bank of England or the European Central Bank. And if we get those divergences, then you'll likely see a big impact in currency markets, with more hawkish central banks ultimately sending their currencies much higher versus their peers. And historically, stock markets whose domestic central banks have been more accommodative usually have fared better. And we actually saw this play out in recent days, because after that stronger than expected inflation data in the US, the dollar rallied and it had its strongest week since 2022, and it hit a 34-year high against the Japanese yen. And as a result, the Nikkei 225 burst higher, and it was actually the best performing stock market last week. Meanwhile, US stock markets endured the worst week they'd had since October. Now, the one silver lining for UK investors is that the pound fell against the dollar by more than 2%, which provided a bit of a currency boost, at least, to any US holdings they have in their portfolios, which limited the damage to their portfolios overall caused by that slump in US stocks. With rate cut odds falling and bond yields spiking, as demonstrated by the 10-year US Treasury yield, it means that the return for the average UK global bond fund is back below zero for the entirety of 2024. But at least one asset has continued to shine brightly throughout all of this, and that's gold. So since the start of March, the rise in the price of gold has been somewhat unstoppable, rising over 18% in just 2 months alone. So this is despite the strengthening US dollar, which is normally a negative for gold, and the market's more hawkish view on the likelihood and timing of US rate cuts, even as bond and equity markets experience something of a reset following the stronger than expected US inflation data. The price of gold was up 5% at one point in a single day last week, and it had 5 consecutive new record high days in a row. And it means gold's rally is to a certain extent hard to explain, certainly defying conventional thinking as what drives its price. Now, there are a range of theories as why gold is going skyward, and it could be central banks buying gold in case the US dollar is used as an economic weapon. It could be because the metal is being used as a haven due to those geopolitical tensions, but those tensions had existed prior to this rally, but it could be spurring it on once again. Hedge funds could be buying the asset as an inflation hedge, or it could be being used as a bet that the US economy will actually have a big slump and the Fed will actually slash rates rather quickly. It could also be algorithmic trading has tried to exploit the upward momentum. It could be any one of those or all of those or none of those, but it means that it's difficult to say what's going to happen to the price of gold or whether we're going to get something of a reset. Personally, I don't really care because I've been riding that momentum with my own 50k portfolio on 80/20 Investor because gold is one of my core holdings. So to summarize all of that, 2024 so far has been a dismal year for bond investors as they've been growing concerned about a second wave of inflation. Equity investors had been largely dismissing that prospect, but in recent days they've started to face up to that potential reality. Now, if you throw into the mix the geopolitical concerns emanating from the Middle East, investors are growing more and more cautious. And so it means that we've seen a little bit of a pullback in recent days. And is that going to continue? And are we about to experience the first serious pullback of 2024 for equity markets? Now, that is it for this month's episode of Damien's Market Update. If you've enjoyed it, do make sure you hit that like button, but also subscribe to the channel.